Hi, and welcome to the Industrial Insider. I'm Jonathan Gornstein, your real estate specialist. Interest rates are a hot topic these days. Are they going up? Are they going down? Are they staying flat? Should I do a 1 year, 3 year, 5 year? Who knows? My guest, Jordan Samery, knows all about that. He's been in the mortgage industry for roughly 15 years and recognizes as a top sales advisor at one of the largest banks. He's known for his customer first expertise and his market analysis. And some of you may know Jordan for his quick tips, insight videos on Instagram at Samery Mortgages. Welcome to the pod, Mr. Jordan.
Thanks, John. How are you doing?
I'm doing well, thank you. I'm sure you're busy with everything going on, so let's just jump right into it. Do you want to give us a little outline about the Sherwood Mortgage Group, and then we'll jump from there?
Sure. So Sherwood mortgage brokerage. Essentially, we work for our clients to find the right mortgage financing solutions, regardless of the situation that you're in. So we have relationships with over 50 different lenders, and that runs the gamut from your big banks that you see on the corners everywhere that you go, alternative solutions like trust companies, credit unions, monoline lenders that don't have banking locations. Then you have B lending spaces and, of course, private lending spaces for more tailored solutions for clients who can't fit into those boxes. So we work directly with our clients. We get to know them, understand their needs and goals, and then figure out what's the right option for them. How can we get the best rates and terms to help figure out whether it's buying, refinancing, renewing, purchasing an investment property to get it done.
Okay. So given everything that's going on, what is your take on interest rates at this point? Going up, going down, inflation? What's your take?
Yeah, it's been an interesting last year or so, as I know that you know, and we're sort of we're at an interesting point in the market right now where it seems rates have peaked.
Yep.
And it seems buyers think that rates have peaked because the market is starting to creep up and warm up a little bit more. We're seeing multiple offer situations again. We're seeing houses selling above listing again. The truth is, we don't really know. There's still a lot of variables out there that could impact the interest rate market over the next 3, 6, 12 months. But it seems clear that as a trend, we've, if not completely hit the peak, have more or less hit where we think rates are not going to get that much higher anymore, which is leading people to get comfortable with what the new interest rate environment looks like. Can they afford their payments? Can they buy that new place that they've been looking at? The next few months, we'll still probably see some volatility. We've seen rates drop over the last couple months and then come back up slightly. But I think in the next year or two, we're definitely going to see rates come down pretty significantly from where we are. Maybe not necessarily back to 2020 levels, but certainly a drop is what we're anticipating over the next year or two.
So what do you think that timeline is going to look like? Do you think we'll start to see a drop Q4, or do you think will be a 2024 gift?
Well, I think it depends also on what sort of rates you're talking about, right? Because the Bank of Canada, which controls the variable rate market, Bank of Canada announces their overnight lending rate, which impacts the bank's prime rate, which obviously impacts variable interest rates. They're probably not going to decrease until late into 2023, maybe early 2024, depending on inflation and, if and when this hard recession comes and how hard it is.
Right.
But I think fixed rates, which move not as a result of the Bank of Canada, but as a result of the bond markets, more anticipating what's going to happen with the Bank of Canada. I think in the fixed rate market, we can, and in some cases have seen a drop already.
Right.
And I think the expectation is that unless things really change significantly, either we get a much worse recession than what we're expecting, or if inflation somehow starts ticking back up again, we'll probably see a continuous, steady decline in fixed rates towards the end of this year.
I don't know if there's a blanket statement for this question. What are, I guess, your clients doing to get deals done currently? Like how are they moving forward? What are you providing them to kind of make transactions move forward? Like, can you give us any insight? Like, is there a blanket statement that you can give us, or it's client by client?
Yeah, that is a great question. And the truth is that it really is client by client. I think one of the advantages of working with a mortgage broker is that you're not tied to one specific bank's rates or policies or options. And so
Right.
we really do look at the entire range of solutions for every client. I think if you could make a blanket statement, it's that it probably doesn't make sense to be looking at a long-term fixed rate at this point,
Right.
given that rates are very high and we expect that they're going to be coming down.
Right.
And depending on the situation, taking a variable rate, which is typically you take a variable rate because it's lower than a fixed rate, and you're taking on some element of risk that rates aren't going to go up.
Right.
Today, that's sort of flipped in that the variable rate now is quite a bit higher than what a fixed rate would be.
Right.
So there's some reasons why you might take a variable. There's a little more flexibility there if you need to pay out your mortgage or refinance or sell your house. But I think most people in most cases are probably looking at somewhere in that 2 to 3 year fixed rate range to bridge the gap, to give them some cost certainty now,
Yep.
and then bridge the gap to be able to renew or refinance in a couple years down the road when rates have really come down, we hope, relatively significantly.
And then let's wind back the clock about 24 months ago, and you were doing 10 mortgages. How many of those 10 mortgages would be on a variable versus fixed?
Yeah, the majority for sure. 7, 8, 9. I think and there's good reason for that, right? In the long run, over the last 60 years, if you draw out the chart, there really hasn't been a 5-year term where the variable rate hasn't won out in terms of saving customers more money over that entire term, right? And then you add to that the flexibility of variable rates typically having lower penalties to break. Most mortgages don't go a full 5-year term before you either sell the house or you have to refinance or you want to consolidate debts. So variable rate had been the choice for a long time. And like I said, it hadn't really lost out until this period.
Right.
And so very quickly we saw that sentiment change to, okay, let's put the brakes on this. We're not sure, or for sure over the last year or so, how high variable rate's going to go, how quickly it's going to go. I don't think anyone would have anticipated how much and how quick the rate would have gone up. But yeah, vast majority of mortgages were set in variable for sure over the last couple of years.
And then as we fast forward to today, what's your take on those 10? Are we still at
almost none?
Almost none.
Almost
So everyone wants
very specific circumstances that would require a variable rate mortgage. Again, either because customers looking to sell in a very short term, or they need that flexibility for some other reason, or they really just want to take on that risk and they have a personal opinion that rates are going to come down more quickly than maybe the market does.
Right.
But very few people right now are taking on variable mortgages.
Okay, so how about customer behavior? What have you seen over the last 12 to 15 months? Like, what have you seen that's changed from your client base? What are you seeing?
Well, I think the biggest thing that's affected customer behavior has really been the uncertainty in the market. In how bad is inflation really? How quickly is the Bank of Canada going to raise rates? How aggressively are they going to raise rates? And I think in a certain way, uncertainty, not knowing what's going to happen, can actually be much worse for the economy and much worse for buyer sentiment than bad news itself.
Right.
When the Bank of Canada comes out and says, this is what we're going to do, here's our plan, here's our strategy, people can prepare for that, they can plan for that, they can budget for that. But when they keep coming out and saying, we don't know, it's just going to have to be more and more, it leads to a lot of people sitting back on the sidelines and saying, I'm not prepared to invest in something or commit to something until I know how bad is this going to be? Like, what is my interest rate going to be in 6 months?
Right.
So the last 12 months have been extremely uncertain.
For sure.
And now that we've sort of hit a period where, again, things could change, but we think we've peaked. We're pretty sure we're either at or near the peak of where the rates are going to be. You're seeing people step back into the market and saying, okay, it's much worse than it was a year ago, but I know what it is. I can deal with it. I can budget for it. I can prepare for it. My cash flow is more limited than it was, but I can make this work and let's go ahead and do it now. That's, I think, the biggest difference.
Are you finding a lot of deals, quote unquote, fall apart just given the mortgage component? Like, people don't qualify, they don't have enough bandwidth. Like,
I don't think people necessarily are having deals fall apart. I mean, math is math. People, if you could qualify for $1 million mortgage a year ago based on your income, unless your income's increased significantly, you know, that number is going to shrink quite a bit today. I think people are being much more diligent about getting pre-approved, which is smart.
Yeah.
People may necessarily a year ago have been going into offer dates without pre-approvals, just sort of, you know, on a back of the napkin math saying, okay, we can make this work. And generally it was fine.
Yeah.
That doesn't really work anymore. We had been seeing, especially earlier last year, mortgage approval coming through, no problem there. But then you get to an appraisal stage, and with property values declining, we had a number of deals that weren't appraising. So property would be purchased for $2 million, appraisal would come in at 1.9 or 1.8, and that causes some issues. So not financing specifically, but, you know, a series of events that could create the deal to fall apart.
Well, let's focus
I
on
think
that.
people are just being more diligent and getting their ducks in a row before they go and buy.
Let's focus on that particular comment. Like, you buy a place, $2 million, appraisal comes in at 1.8. What do you see? Like, what's happening?
It's a very tough situation. There are limited options when things like that happen, because banks, and I guess we're talking about, you know, bank and trust and credit union lenders at this point. They'll only lend a maximum of, you know, 80% generally, unless it's an insured mortgage, but 80% of the value of the property based on the purchase price or the appraised price.
Right.
So if you make an offer to buy for $2 million, you owe that seller $2 million. Even if the appraisal comes in short, the bank's going to say, we're only going to lend you 80% of 1.8 million.
Right.
But you have to make up that difference now in your down payment.
Right.
So if you don't have access to that extra cash flow, you're left with either an option to figure out a way to get the money, friends, family, or look at a private lending solution. So that has been an option for some people, unfortunately, having to go to private lenders who will lend higher values, obviously with much higher rates and much higher terms, hoping that you know, within the next year or so, the property value will increase and then they can refinance it back at a bank again. I mean, unless you can get another appraiser to come in and reappraise the property again at a higher value, that has been the biggest. And it's not as much of an issue anymore. It was more of an issue sort of earlier into 2022 when values were sort of rapidly coming down. That's slowed a bit. But yeah, that was a huge issue for sure.
Why don't you give us a little bit of insight? What's the difference between an A lender, a B lender, and even private lenders? What's the biggest, what people should know going into this? If you could put them in different buckets. Sure.
So the A lenders, we're talking about the big banks, monoline lenders, your TD, Scotia, RBC, HSBC, then you got, First National, non-bank, but large regulated billion-dollar companies.
Yeah.
They are there for clients with straightforward income, sufficient income to qualify based on the stress test, good credit bureaus, good profile, right?
Yeah.
If you fit in the boxes, you're going to get the best rates, best terms, great options, easy goes. There's some flexibility there to make certain exceptions when it's warranted. If you have net worth, a lot of money, self-employed people can make certain income exceptions based on what they declare, but that's really it. You have to fit into their box.
Right.
The B lenders exist as a regulated option, but with more flexibility to do common sense lending. So they can look at someone, for example, who's self-employed and say, okay, you declare $60,000 on your taxes, but we know that you're writing off a lot of things that's not really reflective of what you actually earn and your capability to pay these loans. Right. So rather than looking at your tax assessments to figure out what your income is, just give us 12 months of your bank statements, your business accounts. We're going to go through those statements. We'll count up all the deposits. We'll figure out what your actual real business expenses are. And that's what we're going to use for your income. And these B lenders have the ability to do that. And they charge a slightly higher interest rate, perhaps some upfront fees. But for a lot of customers, it's a way to get into the market to get their financing in the easiest way possible. Private lending is really a Wild West. There are private options that are straightforward and have policies and procedures and boards of directors, and it can go very smoothly, and you get your money and then you renew it at the end of the year, or you move it out. And then there's people in their basement that have a line of credit that they want to lend to friends and family and anyone else that'll take it. They can charge whatever they want. They can lend to whoever they want, and they can ask for their money back whenever they want. So you do have to be careful when you're looking in the private space, because there's a big difference between reputable lenders and, let's say, less reputable lenders.
Right.
But really, these options are there for people who need it, right? B lending and private lending is meant as an alternative solution, not a plan A. You always hope to, if you start in a private space, to sort of graduate yourself up over time. But yeah, it's important that you lean on and can rely on an expert or professional to sort of guide you. And there are pros, there are cons. Not everyone should be in the A space. Some people should be in the B space.
Right.
And that's okay. It's not a bad thing. They're there to help people who need it.
Okay, well, I think you've given us some good insight. Do you want to just give us your, I guess, forecast of the next 12, maybe in 24 months, or what you think is going to happen in general? I know we've touched on it a little bit, but why don't you put your stamp on it, and we'll rewind this thing back in 24 months and see if you were right.
I'll take my crystal ball out and I'll look for this on freezing cold takes.
Perfect.
I think it's clear that things have slowed down.
Yeah.
As people are unsure of what's happening, rates are getting more expensive. People's income just doesn't go as far.
Yeah.
As inflation cools down, as the Bank of Canada eventually, whenever that is, starts to decrease rates, I think it's clear that especially in hot areas like the GTA, you're going to see property values start climbing again. You're already starting to see that to a lesser extent now. The biggest thing that we're still sort of waiting to see whether it happens is that we haven't seen a big growth in powers of sale or people defaulting on their mortgages.
Right
now, inventory is very low, and that's causing prices to sort of stay high. So if we start seeing more and more houses come on the market as a result of defaults or powers of sale, or people just saying, I can't afford these payments anymore, it's been too long, that might cause further decrease in property values. But I think over the next year or two, we're going to deal with some volatility for sure. There's going to be increases in the market. There's going to be decreases in the market. But over the long run, there is still way more demand, particularly in the GTA, than there is supply. It's going to still demand, property values to go up. Yep. It's still going to be challenging and difficult for first-time home buyers to get into the market. It's a tough place to be, but that's why you need trusted professionals, a great real estate agent, a great mortgage professional, real estate lawyers who can guide you through the process. Yep. Because, you asked me what's happening in the next year or two. Nobody knows. I don't know. I think over the long run, it's clear that we're probably going to see property values continue to go up again. Yeah. But how much and how soon? Do the best that you can. Get all the answers up front as much as you can. Make the best decision for you in the moment.
Yep.
And that's really all that you can do. Be educated, get yourself prepared, get all your ducks in a row so that when the time comes that you need to renew or refinance or buy, you're prepared and you make the right decision for you in that moment.
Perfect. So I guess you're getting your golf game ready for the summer?
Oh, you know it. I'm looking at the green grass outside and I'm itching. I'm itching to get out.
Okay, well, thank you for your insight and being a guest on the Industrial Insider, Jordan. Just a reminder, the Industrial Insider is seen on LinkedIn, Instagram, and YouTube. If you have any questions or comments, please email me at jonathan@leonard.com or give me a call at 416-471-0904. Thank you.